Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Okay, start off with a few disclosures. Remember, on Mondays, we look at the indexes and the sectors. On Thursdays, we look at some of the kind of more detailed news happening in the terms of individual stocks and um, like real kind of news and trends, um, thematic things. But we really look at the sectors and the big S&P this week. And it's a very you know, things have been pretty much unfolding as we had outlined a week ago. Um, and we have this kind of shift. Well, we basically have seen we got sucked down the range and we've had the shift toward a recessionary narrative emerging in the market. So this is the S&P 500. Let me start off also by showing you some standardized returns of some ETFs that we're going to be using here. And I'll say the big thing that stands out to me here is there's been a shift toward value and equal weighted sort of things. And that's not just kind of abstract about value, it's specific to consumer staples, healthcare, real estate, and financials. And in particular, in financials, something that's kind of weird about it is that the strength in financials is coming from property and casualty stocks, not necessarily the banks and the more cyclical names. So this market is painting right now something of a recessionary picture. Let's go over here and look at um, this thing on radar screen. It's a very unusual sort of setup right now. This is the S&P 500. So the S&P right now is down about 0.74%. But if we look at the S&P itself, at this list here, we can see that, well, almost half, when I first created this list earlier, almost half of the index was positive. So that's just kind of interesting. 233 stocks are green today. Look over here on our empty breadth workspace, and we can basically see that there are a lot of stocks making new highs. 57 new highs in the S&P 500 today, new 52-week highs. That's what this shows us. Now, this workspace is from Market Trends that we do on Thursdays. We share the zip file. If you go to our blog, we share all this information if you want to be able to access these workspaces. So I'm very quickly go back and look at some of these ETFs and just highlight what I'm saying here before we move on to the charts. And the key point here, if you look in the last week, you can see real estate, consumer staples, healthcare, utilities are outperforming. Okay. Now let's go back over here and look at the stocks that have been outperforming. Or here, this will show us the stocks that are basically making 52-week highs today. This indicator, we have a real estate company, a life insurance company, a real estate company, a pharma company, medical devices. Here's one kind of quasi tech stock, which is Paychex, a few industrials with them back, utilities, real estate. So basically, what we're seeing here is we're seeing the non-cyclical stuff, things like real estate. Even Waste Management is not really a trucking company. I mean, Waste Management as a garbage hauling company is usually considered more of a safe haven. So we're seeing essentially a sort of risk off cautionary sort of thing, which is more or less what we had discussed and narrated a week ago when we talked about some of the economic data. So this has been more or less playing out. So now I'm going to put away my TradeStation platform for now. If you want to see more, go to tradestation.com. Some of the things we're going to be talking about are covered in our blog post we did today. So go to tradestation.com and click on Insights. If you're viewing this on YouTube or Facebook, there's actually a link um, to this article directly. If you want, if you're you can view it here, or you can go through that link in our description. But this article outlines some of the things we're seeing on the S&P 500. So if you look at the S&P on the daily here, we hit some real oversold levels. We noticed these new highs coming, and we're at a spot here. We had a little bit of a false breakdown, and now we're trying to basically hold 5,900 on the S&P. And I think one of the big things right now is that last week, look at the S&P now. It's a big chart we look at. We warned or mentioned the potential of the S&P getting sucked down this range toward 5,800, which is exactly what happened. That big tail we had, you can see on the weekly candle here. And now basically we're in a spot where we're seeing yields go down. We are seeing things like real estate do well, things like consumer discretionary do poorly. Those are the things that we had more or less been highlighting as possibilities based on the chart work a week ago, and that has been playing out. So now we basically have today another weak data report. This one is the Institute for Supply Management Manufacturing, shows weak production, weak orders. And the main reason why it was positive, from what I can tell, is that prices went up. So we are seeing higher prices, weaker production, jobless claims spike last week. This is, I'm not saying we're in stagflation, 1970s recession or anything like that. I'm just saying that the direction of the data, the message, the moral, so to speak, of the story coming out of the data has been recessionary, stagflationary, and that's what it is for now. But let's just remember that that is what's out there. It's not to say that's what's going to happen. It's just saying that that is what has happened. All right. Now, it's also important to realize that sentiment is incredibly bearish. If you look at the American Association of Individual Investors last week, it hit the lowest level since late 2022. So we're at a spot here now where there's a lot of fear and negativity, and we have to just kind of, recognize that a lot of negativity has been priced in, and we basically managed to hold our level from 7 weeks ago. So overall, there could be a spot here where things want to maybe flip, and I want to just kind of point that out because there's a lot of bearish sentiment. There's a huge amount of cash on the sidelines if you look at the retail money market funds, and then also at the same time, earnings estimates are getting cut. But at the same time, we're in this weird spot where there seems to be this expectation by belief by businesses and executives that Trump is not going to really follow through on these tariffs. And so I think it's something here where, I'm not going to try and predict what he does, how exactly this thing plays out. But I think it's important to realize there is a certain expectation that these tariffs are going to go away. And the other thing is that if we do see we do see more recessionary thing, and we saw that last week with the, GDP now from the Atlanta Fed going negative. If that plays out and we see, tariffs hurting profits, but also causing some kind of business slowdown. And I think it was just today, was it JP Morgan? Someone basically said the economy was like could get to a spot when like businesses just kind of stop because of the uncertainty. And that's kind of what we had mentioned last week. And it kind of seems to be what was being played out in the jobless claims. So we're at a spot now where some of these fears are kind of playing out. Now, the thing to remember though, is that Trump can just take that away to any time and says, oh, I'm happy now. Mexico is doing a good enough job with their policing the border. And today there was a headline coming out of Mexico from their president saying, oh, we are cracking down on cartels and stuff. So Trump could just maybe flip and say, hey, we're happy with Mexico now and no more. And then, so we just have to realize that these are things that are kind of discretionary that could kind of flip away. So I want to just point that out. There's a lot of negativity. There are things that could make people really negative. And the market's focusing on that, but at the same time, we have these uncertain events, and it's just pure uncertainty at this point. And I think people have to realize that, and also realize what are the catalysts, at least from what we can predict. State of the Union's tomorrow night, payrolls Friday morning. So those are the things we highlight them in our article as well. If you go down to the bottom of this article and read, we highlight the upcoming events. So we showed this on the daily, just the main things I wanted to point out. Now. Also, very quickly, I want to mention a couple of stocks, a few stocks, three stocks, Airbnb, individual stocks. I just got to kind of mention them because, to me, it's interesting to see these companies that are kind of like, you could make a belief that they're longer term sort of permanent players in the economy. Airbnb, strong earnings, has retraced the whole move. Reddit had, not a great earnings report, but a lot of people were saying there was a certain thesis that the thing that dragged them down is not going to be a permanent condition. It was a weird thing with the way some search engines were working. It's been holding this level around 155, 156. Reddit, RDDT. Now remember, these are all kind of companies that they're not massively big yet, but they seem to be in a spot where they are kind of like new players in the new economy. And I think that's important to kind of realize, people looking for that longer term sort of growth narrative, maybe not something as big as a Meta or an Amazon, but a company that you can believe that is on that growth trajectory. Reddit, Airbnb, both of them have pulled back. The other one is Uber, has also kind of had this rally on decent earnings and has pulled back now, and you can maybe see this. So we don't normally talk about stocks in this, but I did want to mention here that these are names that people are probably not as heavy and as concentrated in. And if you are kind of migrating and taking long-term money out of massive mega cap names and looking for other names, two of these stocks, Uber and Airbnb, are in the S&P. So I mean, you can kind of look at that, and these are names I just wanted to point out because I just I'm interested in always trying to kind of point things out that are of interest to customers and traders. So anyway, the big thing we do in this webinar, we look at the indexes, S&P 500 essentially here, held that, it sucked down that range as we expected. And like I said, we have a lot of time this week. And I think, trying to essentially hold 5,900, there's really, from what I can see here, no real clear edge one way or the other. Things could get ugly and get sucked back down. Trump could say tomorrow that the tariffs are going away, and we're gonna reverse to the upside. There is this trend line that has that you can see as a potential resistance area that cleared. But in my view here, this is something where we are in this kind of range, and I do think it's important to realize that if things don't work out tremendously well, I mean, 5,700 is a level that exists on the chart. And when volatility increases, ranges widen. And I think we have to realize here is that this range here has been in place really since mid-December. Excuse me. And if people are looking overall for volatility or things that get worse before they get better, 5,700 is not a crazy spot. It basically goes back to the high from mid-September. It was the low, actually, of election week, before the market rallied, I believe, on election day, which was the 5th of November. So this was the low right before the election. So if things if things don't turn out wonderfully, and more of a negative scenario plays out, people might want to have this 5,700 number on their overall chart. Now, the Qs are in a very similar sort of spot where, we had talked about getting sucked down this range, but again, maybe the level that we need to think about if things remain in a kind of a bearish condition is down toward 484 on the Qs. Same thing. It was the low from back here at end of October, early November, right before the election. And that, again, when things get volatile, you will often see ranges widen. This has been a tight range we've been in here for a while now. And if people look for the negativity to continue, then a widening out of that range might actually be something that people kind of see the potential for. Now, the Dow is in a similar spot. It's been very interesting to see the strength in the Dow. And one of the reasons is because the Dow has that value aspect to it. Value's been outperforming here. And so I think this is interesting to see if it can hold this. And if it does, it could really kind of confirm this switch back to the kind of value trade. And we could enter a period of time when the Dow takes leadership from the NASDAQ. So I think that's maybe now something we have to put on our radar as a potential. Mark Douglas says you have to be open to the now kind of flow of possibilities, as a trader. And I think right now, the thing that we might actually see is that we could have a period of time when the Dow Jones Industrial Average rallies and the NASDAQ goes nowhere. So maybe this is telling us something, the fact that the Dow is holding its levels from January while the Qs are basically, well, they're also holding their levels from January, but I mean, this is range bound sideways. So it's maybe just something I think here when we look at it, the Dow has that aspect of being value, and it has held up better kind of in the shorter term. Last week we saw a greater, a better performance in the Dow and in value stocks. And I think we just need to realize, if you look at the chart here, this has been holding kind of a higher level. And so I think this is something people might want to realize, that this could be the place where leadership could be going. Now, the Russell is, in a tricky spot. And I think that we have identified this as being a risk area. I think when you look at the economic data, it's this is maybe it's the sector or the index everyone loves to hate. And I think at this point in time, this zone from down here is something that I think remains something people need to be aware of. And so this is an area I think we need to realize that we're basically below, our support from before the election. This was before the election here. This is back here in the October levels. This is the election day, the period before the election. So basically, on their respective charts, the S&P and the Qs are holding this level. The Nasdaq is not only, I mean, the Russell is not only below it, but it's below the levels from the beginning of October. So I mean, the Russell here just remains kind of the laggard. And I do think we need to be realized that there is this space down here, potentially to the lows from early September or all the way back to the lows of August. So that's what we see on the Russell. Go to the 10-year. Now, we had talked about the fact that there seemed to be demand for duration with the potential for a move toward 4.1 on the 10-year. and that's more or less played out. I think we have to realize here is that this is overall not a great thing. If this is consistent with a recessionary view. I don't have the yield curve on this, but the yield curve has been moving back toward inversion or flattening. Essentially, people saying longer term, um, you know, yields could be lower, and that's not because of inflation coming down. It's because of the risk of recession. So, I mean, what we're seeing here is something that is a little bit more of a bearish decline in yields. This is not really a healthy decline in yields that would be the kind of thing we wanted to see before. This is now, people have said for a long time, if yields move down because of economic worries, that's not great for stocks. And now they are moving down because of economic worries. So I think this is something we have to realize, and this level here is one that we had mentioned, and we're moving back toward it. At this point, I don't see any obvious opportunity with it, or anything that that really has an opportunity. But I want to just point out that this has played out as we expected, and at this point, it does have some risk of just kind of staying around 4% and essentially kind of becoming a risk off vehicle. And the thing is, if we do see more downside in the market and economic worries, there could be more downside kind of in TNX. We're getting to a point here where this could almost be a bearish indicator. If we see more downside in TNX, this really could be something that drives the VIX higher. Now, the materials index XLB is, I mean, it seems to be turning old support into new resistance. This is a highly cyclical part of the market, and it's not breaking out. And this is one where if we get more sort of recessionary thing, I mean, I think this is one of the things to realize is, you might want to put tariffs on foreign steel and stuff like that. But if people see the I got to just show you this from the Atlanta Fed. I hope you guys saw this GDP now. I mean, this is kind of incredible. Was basically, it went to, I haven't looked at it. Wow, it went lower. So now it's a minus 2.8 after the ISM today in construction spending. Wow. I mean, that's pretty incredible. I mean, honestly, I had not looked at it today. So, I mean, this is not good for materials. Materials are cyclical. So, XLB here hitting this resistance, and I think, this is something that, should basically, people, if people think that this kind of weakness is going to extend, a revisiting back toward 82. And I think the thing to realize is this is a lower high. So, I mean, the fact is a lower high might be followed by a lower low closer toward 81. So XLB here, I want to point that out. Old support, new resistance, potentially lower high, and a failed breakout really against January of 2022. So that's XLB. Communications remains a healthier part of the market. We talked about this. We had talked about the risk of it getting sucked down into this range, and that is a potential risk here. But communications in some ways remain, I mean, they don't have a lot of tariff risk. There are companies like Netflix and Meta, and also some of these telecommunications, and also companies like Fox. Some of these traditional media companies have been performing well. Some of the telecoms like T-Mobile and AT&T have been performing well. Stocks like Netflix has been performing well. So you have Netflix and Meta, which have been transformative stories. And you have these other names in there, like the telecom names that have been doing okay. And then you have the traditional media names that have basically had some degree of turnaround doing okay. And so I think right here, if there is a growth part of the market that is performing best, and we're seeing it on the chart, it has been XLC. Nonetheless, it has now something of a failed breakout with the potential of getting sucked back into this range. XLC. Now, XLE. So today, the OPEC confirmed that they are going to increase oil production. I thought they had done that already. I'm not really sure. Oil moved down sharply on this news. I mean, it seemed to be stuff that was already known, but I think, again, also we're in a spot here where if we are looking at, minus 2.8%, now remember, this is not a real estimate, but it's basically a kind of guesstimate thing. It jumps all over the place from the GDP now. The key thing, though, is if this is a trajectory right now and we're getting increased oil production from OPEC and we're getting this kind of recessionary narrative, I mean, this is something where we had talked about the triangle, and we basically said if we break under 90, that's why we drew this line. So in fact, I want to point that out. 90 was our level to watch on this. This now turns into potentially, let's look over here on the daily XLE. This now turns into something where people might start to think again. And we had talked about an XLE for a while. If this, I mean, a move back toward 83, but then even down potentially toward 80. So this has really gone sideways for a long time. And I think that, we've talked about the fact that the energy situation, I think we also, well, the energy situation is a secularly weak area globally because of the fact that countries are becoming there's increased production for one thing, the United States, but not just the United States. There's other countries in OPEC that have been active. There's I'm not even sure some of the smaller countries, but there have been various countries increasing production inside of OPEC. And at the same time, we have essentially a secular move away from energy. But the other thing is, if we get some kind of resolution to the situation in Ukraine or whatever, say something happens at some point when sanctions on Russia are to a certain extent reduced. I mean, the the pressure on energy will probably be to the downside from something like that. The idea of a major producer like Russia returning in some way more to normalcy as a supplier in the market is not going to be probably super positive. So I think this is something we have to realize, is that energy has a lot of these negatives in front of it. And today we have a bullish outside week and a failed breakout, and we're under that 90 level that we've been watching. So from my view here, something like energy downside might be something people kind of look for. And, the move here, it is pretty interesting to see us back under the 50-day. From my view here, being aware of a level like 83 on this is maybe something people want to be kind of looking at. XLE, XLF is the financials. And, I mean, this is one where it's really interesting if you look at European stocks. I mean, Europe's been a bad economy for a while now, but their banks have been just going straight up. HSBC and these different banks have been performing really well. And there's a narrative here that doesn't get a lot of attention, but essentially, after the financial crisis, the regulators put a lot of pressure on the financials and basically made them very strong financially. So aside from a few random blowups like Silicon Valley, the overall financial systems in both Europe and the United States have been really shored up. And so I think the thing is that as that regulation eases, these companies, simply by having less restrictions on their business, can make more money, and that can boost earnings alone. The other thing is that basically, well, they have the value proposition. So if money is going to be leaving the large caps and people say AI is played out for now, healthcare and financials are the two most logical places for institutional investors to put that money. The other thing that's been happening here has been the names like, I mean, actually, I wanted to mention today, Allstate has this kind of interesting sort of breakout. I'm sorry, please don't throw tomatoes at me for, I mean, I know it's not very interesting. People don't like property and casualty stocks. People think they're boring or something. But the thing is that there has been significant bullishness in the property and casualty space. Things like Erie Indemnity, which is probably a really obscure company, but had this really, big surge last week and again today. I mean, these are just random names in the S&P, but the one that actually did grab my attention was Allstate. Berkshire's breaking out. In fact, AIG, which used to be a blue chip stock, is now probing levels going back to like 2009. I don't have time to get into it, but another property and casualty stock. Anyway, that's what's happening in financials. So I want to just point that out. Is basically the financials here, the XLF, is kind of holding tight near those highs. And from my view here, this is something where people might want to be thinking about 51.3. And then that's roughly halfway up last week's candle. But last week we had this big bullish candle. It got rejected under that support level, or it got bought up. So it tried to go under 50, basically in a half, and it came roaring back. And so from my perspective here, this fits into what we're saying, which is the value thesis. And also, it's interesting that we have now a model, which is Europe. Europe has been economically weak and financials have been strong. Financials are not supposed to do well in a weak economy, but it happened in Europe, and the same thing is potentially happening here. And you can see that people are talking about Trump reducing regulation on financials and banks. That has been a narrative, and it seems to be applying here. So remember, in the markets, nothing is always true, and there things can change. Sometimes a stock that should be cyclical can become less cyclical, and an area like utilities that are not supposed to be cyclical can now be suddenly tied to tech, which is what we've seen with utilities and AI stocks and the data center electricity narrative. So anyway, I want to point that out. This is a narrative that's playing out, and it's a trend that seems to be in place for financials. People might want to see if we can hold, maybe dig down a little bit more, kind of 51 and a half, 51.3. But financials seem to have this sort of buoyancy in them. And this is, one thing that stands out to me here. Industrials, on the other hand, in my view, remain. I mean, this is, I would say in my view, but we look at my chart here, we can see we have this channel in play. The valuation on these is very high. They have a lot of other random things that could potentially hurt them. Industrials are more economically cyclical in a way. They also trade at pretty high multiples. Some of these stocks have gotten pretty expensive in the last 10 to 15, the three to last 2 to 3 years, I should say. The valuations have gotten pretty high on them. The other thing is that they have a more AI exposure than people realize. There's been this sort of heating and cooling HVAC AI narrative built into industrials here. They're cyclical. They have the AI exposure. They have high multiples. Some of them have risk of the Defense Department cutting budget, Pentagon budget. So they have this channel here. I want to point that out. This channel, you know, potentially leading down toward 130 on the XLI, maybe wants to be on people's radar. Now, XLK, very similar here to the Qs, and I got to say, we're under this weekly support level. It's really, I think at this point, this is a big issue. This is the biggest sector in the market. And I think right here, we need to really be aware because, there is some areas around here. I think maybe 219 would be the next level on this to really watch. But this is something that is at risk. I think people need to realize that, again, a tight range that might widen to the downside. So I think this is one here we have to realize that we're under important support. And then there's, potentially some more, space here to the downside. So I think we need to realize this right now in tech stocks overall, the XLK showing some, some potential space to the downside at a time when money is shifting away from growth stocks. XLP, consumer staples here, essentially kind of back near its highs, and this kind of fits into a sort of safe haven narrative. I think it's been up now for, many weeks here in a row. But I think there's also is in a spot where if we do enter this sort of recessionary sort of mindset, people might look for this to be a new area of leadership, but it might also entail a pullback down toward 80. This was the level we had identified here where we bounced in before the election, and now we're kind of, we've rallied up to that kind of high after the election, but people might look for a move back closer down to 80 to have an entry in this. Real estate has done very well. We've been kind of talking about what was happening in real estate back here. There were multiple news stories and things pointing to the improvement in the real estate sort of situation. Bunch of bullish outside weeks here. From my view here, this remains potentially the most interesting sort of sector. It's been left for dead, and I think in some ways it's interesting because all the things that I think they've been through, like I said, that first they went through the retail apocalypse, then they went through COVID, then they went through rate hikes. So they've had all these horrible things happen, office vacancies, rate hikes, all this stuff. And now in some ways, like, what is the next thing in front of us? Even if it is recessionary, that would mean basically lower rates potentially. If it is stagflationary, well, they're in a spot where, rents are something that will keep up with inflation for the most part. So they're in a spot here where I think people might look at REITs and actually realize that they are structurally in an interesting spot for the economic cycle here. And in my view, people might want to be thinking about the fact that if we do move toward a recessionary thing, this is an area that has potentially a lot of space to play catch up relative to where it was back in 2021. It's the only sector that's not gone back to 2021 levels or 2021 highs. So people might see some space in this to the upside. XLRE, XLU, utilities. See, now we have a range in this one between 80 and a half, actually 80.44 and 75.58. This is a range here we did not break out, and given its association with AI, this also might be something where we get some suction, some down into the range, back down the range, and I think right here this is range bound with maybe people looking for their lower support to come back into play. Healthcare, another one here that's had this interesting sort of breakout. We did a trading view idea on this today. In fact, if you look at our trading view, we basically if you go to, I don't have time right now to show you, but on TradingView for TradeStations ideas, we basically looked at on the daily chart, but we noticed that this was basically on the daily chart, XLV had a bullish outside day on Friday. There have been some interesting things in here, and I think it's also a value sector. It's a non-cyclical sector. It's a safety play. I think right here it's interesting. Also, it has this high, so it's interesting to kind of realize that this stock now is basically has some potential space to the upside, and it basically broke an intermediate term resistance level that had held it in check for several weeks. That was the highest weekly close back here since basically the beginning of November. So basically, when we see a strong weekly close, it's often been followed by more strength. That's been a pattern we've seen on the weekly chart of these sector funds, and that's what we're seeing now. That's XLV. XLY, on the other hand, we had warned about, kind of not warned, but we had kind of talked about the fact that this was an area that had a lot of potential issues with Tesla, with the economic worries. We've seen spreading issues with things like the cruise ships, things like home builders. Consumer discretionaries are not something people normally are going to embrace at a time of economic weakness. So if we do see a sort of recessionary narrative or theme emerging, XLY, could be something that kind of has issues. So from my view here, this is kind of like XLK. It has broken support and it has potentially some real space. Now we do see here there is a low it's trying to hold from basically right after the election. So, we don't want to be, overly kind of negative but we also have to just kind of realize here is that if things get difficult, this entire surge up, could be something people could become like an air pocket that people look for it to get sucked down and fill. So that's the main thing I want to point out. But overall, here, the things that were standing out to me was healthcare, real estate. Those areas continue to have this overall sort of strength. But I think the main thing here is that the yields are now telling us more of a negative story. But at the same time, we have to realize that this negativity is now very well known in the market. So we could be at a spot here where, I mean, less than 20% bullish on the AAII survey. A lot of this now is kind of known. So, we have to be at a spot where we realize that there's a lot of negativity that is priced in, even with the sort of some of the negative things we're seeing on the chart. So last thing, just go back to the S&P here. We are kind of holding 5,900. 5,900 itself is not an enormously important level, but it is a nice big round number, psychological level here. So like I said, State of the Union tomorrow night, we have some space, we have some time, and people very well could wait and kind of see how things play out before doing much with the index. So hope everyone has a great day. We'll see you on Thursday at 2 p.m. Eastern time for market trends. Hope everyone has a great day, and I'll see you then.